Welcome to the Deep Dive, where we take the latest financial reports and really break them down into actionable insights for you.
That's right.
Today, we're plunging into NexPoint Real Estate Finance's Q2 2025 earnings call. This is a crucial company operating in that mortgage REIT space, focused on generating income through real estate debt investments.
And our mission, as always, is to cut through the jargon, extract the most critical insights, those key numbers, and the strategic narrative. We want to give you a truly comprehensive understanding without, all the information overload.
Exactly. So let's unpack this. Okay, first up, the headline numbers for Q2 2025. NexPoint reported GAAP earnings per share, or EPS, of $0.54 per diluted share.
Yeah, and that's a pretty notable increase from the $1.00 they posted back in Q2 2024.
It is. But, for a mortgage REIT like NexPoint, GAAP EPS isn't always the full picture, is it? The real pulse of the company often lies in those non-GAAP metrics. Can you explain why earnings available for distribution, EAD, which came in at $1.43 per diluted share, and especially cash available for distribution, CAD, at $0.46, why are those so crucial here?
Yeah, absolutely. So GAAP EPS, while it's standard, often includes non-cash items, think depreciation, right, that can significantly distort the true income picture for a real estate company. EA and CAD, they basically strip those out. They give us a much clearer, maybe more conservative view of the actual cash generated and available to distribute to shareholders.
Actual cash.
And for a dividend-paying REIT, that cash generation is, it's paramount. What's particularly interesting is that alongside these earnings figures, book value per diluted common share saw a modest but positive 1% quarter-over-quarter increase. It reached $17.40.
Okay, so book value up slightly.
Yep. And interest income was also up by $4.6 million year over year, hitting $22.8 million. Meanwhile, interest expense actually decreased by about $0.7 million.
Lower expense, higher income. Sounds good.
These are all positive signals, yeah, showing a real tightening of financial operations.
And on the dividend front, the company declared $0.50 per share for Q3 2025. But, and this seems like the key point, for Q2, that crucial CAD dividend coverage was 0.92x. What does that number, that specific figure, tell us about investor sentiment right now?
Precisely. That 0.92x CAD coverage isn't just a number, it's really the fulcrum of investor concern right now. While it's close to covering the dividend, it's a clear signal that the current cash flow isn't yet fully self-sustaining for that payout level.
Not quite there.
Exactly. This is a major potential red flag for income-focused investors, and it explains much of the stock's immediate dip after the call. It suggests a sort of cautious optimism for management that still needs to be proven through, execution.
That dividend coverage number certainly raises a key question. Okay, let's delve into the underlying currents driving both the positives and those points we need to watch this quarter. What were the primary financial drivers behind these results?
Well, the increase in GAAP EPS, as we touched on, was primarily fueled by that $4.6 million rise in interest income. That's directly attributable to increased income from their investments.
Okay.
And this was notably supported by a reduction in interest expense, which is a direct benefit from their deleveraging efforts back in Q2 2024.
So past actions paying off now.
Exactly. It's a clear sign of financial discipline actively paying off, demonstrating, efficient capital management.
So, okay, while the EAD at $0.43 and CAD at $0.46 show a steady operational picture, that 0.92x dividend coverage on CAD is still kind of the elephant in the room.
It really is.
It indicates that, while very close, current cash generation didn't quite fully cover the dividend paid out this quarter. That puts pressure on future performance expectations, right?
Absolutely. The pressure is definitely on for Q3. And that slight yet positive 1% increase in book value to $17.40. That was mainly attributed to unrealized gains on their preferred stock investments.
Okay, so specific assets helping there.
Yeah, it highlights the impact of specific asset performance within their portfolio. And look, while it's only 1% in this challenging real estate market, any positive movement in book value reflects, sound asset selection and management.
Fair point. Now, looking at the portfolio itself, NexPoint manages a substantial $1.1 billion portfolio spread across 86 investments. That sounds like a decent level of diversification on the surface, but What are the specific advantages or maybe challenges of this particular mix in this economic climate?
Well, yeah, that spread across 86 investments certainly offers some risk mitigation. But the real story, I think, is in the sector concentration. Their portfolio is heavily weighted towards multifamily. That's nearly half at 49.5%, and life science at 32.7%. Big bets there.
So really focused.
Very focused. While they do have exposure to single-family rental at 15.5%, self-storage at 1.6%, marinas 0.7%, and a tiny sliver in specialty manufacturing.
Yeah.
That high concentration in two key areas shows a deliberate, almost thematic strategy.
And the advantage there is expertise.
Right. Deep expertise in those sectors. But the challenge, of course, is sector-specific risk. If multifamily or life science face headwinds, it has a magnified impact on NexPoint.
And geographically, you mentioned Sunbelt presence, but also Massachusetts and California exposure tied to life science.
Exactly. Which makes sense. Those are global hubs for life sciences. But it also ties their fortunes to the dynamics of those specific, often high-cost markets.
But how are they managing that concentration risk?
What's really reassuring, though, is how they manage it. The portfolio maintains a pretty conservative risk profile overall. We're talking 74% of assets are stabilized. Their weighted average loan-to-value, the WALTV, is a prudent 58.5%.
That's fairly low LTV.
It is. And the debt service coverage ratio, DSCR, stands at 1.44x. These are robust indicators of, prudent underwriting and active risk management, especially crucial in a market with increased uncertainty.
Okay, that makes sense. Shifting gears a bit to recent activity, during the quarter, NexPoint funded $39.5 million in life science preferred stock. That's a significant move.
Indeed. And they also strategically purchased a $15.3 million commercial mortgage-backed securities interest-only strip, a CMBS IO strip. This boasts a bond equivalent yield, BEY, of 7.24%.
Okay, unpack that CMBS IO strip for us quickly. What does that mean in practical terms?
Sure. So a CMBS IO strip basically means they're buying only the interest payments from a pool of commercial mortgages, not the principal. It's generally a higher risk, potentially higher reward play designed to capture yield in a specific way, betting on prepayments and defaults staying within certain bounds.
Got it. Higher yield, specific risk.
Exactly. And they also funded a $6.5 million loan at SOFR plus 900 basis points. Quite a spread there. What's particularly noteworthy here is how they're capturing this attractive yield without seemingly overextending a credit in what remains a tight market. They're finding value in these specific higher yielding opportunities.
So selective deployment.
Very selective. It speaks to a very focused strategy.
Okay, let's look at their credit profile and leverage. The company reported $816 million of debt outstanding. What's the cost on that?
Weighted average cost is 5.9%.
And their debt-to-equity ratio?
Sits at a modest 1.14x. And management really emphasized this point. It's one of the lowest leverage profiles among commercial mortgage REITs.
And why is that so important right now?
Well, it's a critical advantage. It affords them considerable flexibility for future accretive growth opportunities, especially in an environment where many of their peers are pretty constrained by higher leverage.
Right, more breathing room.
Exactly. Lower leverage means more breathing room if market conditions tighten further and more capacity to act on deals.
They also described the B-piece portfolio as very solid, which sounds reassuring. But for our listeners who might not be deep into securitization, could you quickly explain what a B-piece is and why its solidity, especially with those watch list items from the 2021 floating rate vintages, is so critical?
Absolutely. So B-pieces are essentially the riskiest, unrated slices or tranches of a securitized loan pool. They're the first to absorb losses if the underlying loans default.
First loss position.
Right. So for management to call theirs very solid is a strong statement. It signals confidence in their underwriting and asset selection for those deals. The watch list items, predominantly in those 2021 floating rate vintages, well, that reflects broader industry trends. Those loans were originated when rates were super low.
And then rates shot up.
Precisely. So they've seen significant stress due to rapidly rising interest rates. Having a solid B-piece portfolio, despite these watch list items, suggests they structured those deals well, even in what was arguably a more aggressive lending environment back then.
So a sign of credit discipline.
A key indicator, yes.
Given those numbers and the context, I'm curious how management is really framing this quarter. What's their core message amidst this, challenging backdrop?
Management expressed clear satisfaction, actually. They called it another strong quarter amidst the challenging macro backdrop. They specifically underscored a disciplined, opportunistic approach to deployment, which is Particularly noteworthy, as you said, in a period of reduced bank lending.
Stepping into the void.
Effectively, yes. Stepping into the void left by traditional lenders, finding attractive deals while trying to maintain their conservative profile. It shows a focused strategy when capital is scarce elsewhere.
And they also recently accretively disposed of an asset called Emford. What's the strategic benefit of doing that, creating that additional liquidity?
Yeah, that's just a smart move to keep capital flowing into new opportunities. By selling Emford, they've freed up cash. That cash can now be redeployed into their active pipeline, potentially at higher, more accretive yields, rather than having capital tied up in a mature asset. Keeps the engine running.
Makes sense. Now, let's talk about their sector views. Management is apparently very constructive on the multifamily sector. Can you walk us through their reasoning there?
Their bullishness, it really stems from a specific forecast they shared. They anticipate new supply deliveries will peak in Q3 2025, so pretty soon. And then they expect supply to dramatically contract, falling to a GFC-level output that's global financial crisis level of just 77,000 units per quarter through 2026-2028.
Wow, that's a huge drop.
It's a massive drop. And this dramatic reduction in new supply directly supports their thesis of accelerating fundamentals and, consequently, higher rental rates in the coming years. It's really a supply-demand equation playing out potentially in their favor.
And it looks like demand is already showing some signs of strength. National stabilized multifamily occupancy improved to 94.6% in July.
That's right. Demand outperformed expectations in the first half of the year. So the market seems to be validating their thesis even before that big supply contraction really kicks in.
Okay, now, here's where it gets really interesting, I think. The life science update, specifically their Alewife project, they've made significant progress closing in on, as they put it, a 245,000 square foot, 15-year lease with an AI-biologics tenant.
Yeah, this Alewife lease sounds like a potentially massive development.
Can you walk us through the significance of this deal? Not just the size and term, but the type of tenant and that projected 8% yield.
Okay, so yeah, the AI-biologics tenant is key here. That's a cutting-edge, high-growth field. And that long 15-year lease term, coupled with an 8% projected yield, I mean, that signals incredibly stable, high-quality cash flow potential from a very desirable sector.
And they expect news soon.
Management expects a formal announcement early in Q3. This lease is seen as a critical catalyst. It's expected to boost occupancy of the first phase to roughly 2/3, a big de-risking event. But maybe even more importantly, it should expand their financing options, potentially allowing for things like back leverage and A-notes at lower funding costs.
Which helps their overall cost of capital.
Exactly. It fundamentally de-risks their significant life science exposure. This isn't just a deal. It's potentially the deal that validates their big strategy in this specific high-value asset class.
And importantly, management differentiated their Alewife loan. They highlighted it was made in early 2024, not during that more volatile 2020-2022 period when some peers saw downgrades. What's the significance of that timing?
That timing is crucial.
Yeah.
The 2020-2022 period saw a huge rush of development and, frankly, often more aggressive lending terms. By originating in early 2024, NexPoint was able to underwrite this loan with much more clarity on current market conditions and interest rates.
Better visibility.
Right. And they specifically pointed to strong sponsor equity and this pending high-quality lease as key protective factors that set their project apart from some of the more challenged life science loans originated earlier. It really speaks to their patient, disciplined approach.
Okay. Moving to self-storage trends. Sounds like a bit of a mixed bag. The sluggish housing market continues to weigh on demand.
It does. But management also noted rising occupancies and improving rates in major markets, which is, a hopeful sign. And critically, new development in self-storage remains below equilibrium, mostly due to limited bank financing and high construction costs.
So supply is constrained there too.
Exactly. This supply discipline is a critical point. It means that as housing activity eventually rebounds, there won't be an immediate flood of new supply to depress pricing. This controlled supply environment is expected to help restore pricing power, creating a more favorable operating environment for their self-storage assets down the line. It's a bit of a waiting game, but the underlying conditions for a recovery seem to be setting up.
Makes sense. The company also boasts an active originations pipeline exceeding $235 million, largely concentrated in the residential sector. That sounds like a solid path for future growth, but what can you tell us about the quality and, maybe more importantly, the conversion potential of this pipeline beyond just its size?
Yeah, that's the critical question, isn't it? This incremental pipeline activity is anticipated to increase their CAD run rate in the high single digits, which sounds exciting. However, the market will absolutely be watching closely to see how quickly and efficiently they can actually convert this pipeline into truly accretive investments.
Execution is key.
Execution is everything here. Given their disciplined approach and that low leverage we discussed, they're well positioned to cherry pick the best opportunities, but they have to deliver.
Okay, let's look at the actual guidance for Q3 2025. Next point, guided for GAAP EPS between $0.43 and $38.20.
Right. And EAD per share is projected between $0.30 and 0.07 cents. And CAD per share between $0.45 and 55.
And that CAD range, $0.45 to $0.55.
What's particularly noteworthy there, and I think this is deliberate, is that the midpoint of their CAD guidance, $0.50, exactly matches the declared dividend for the quarter.
Signaling coverage.
It's a very strong signal from management. It indicates an explicit expectation of full dividend coverage going forward. It's basically a direct response to the market's concerns from Q2, suggesting they're confident in their ability to generate that cash in Q3.
Interesting. And finally, before we get to the investor context, management also shared a very constructive view on the seniors housing space.
Yeah, they agreed with the generally improved fundamental outlook there, citing moderating inflation and reversing delinquencies as positive factors. They pointed to the outperformance of companies specifically in that sector and increasing capital deployment in highly amenitized senior housing projects.
So maybe a future area for them.
It identifies it as an attractive area for potential future exposure, yes. It shows they're looking strategically beyond their current core for new growth opportunities. Suggests they're actively monitoring for the next wave of potentially accretive investments.
Okay, let's try and connect all this to the bigger picture, the investor context. Despite management's generally positive tone, another strong quarter commentary, NexPoints shares dipped down 3.8% on the day of the earnings call, another 0.9% the following day. Trading volumes were pretty average, so no massive sell-off, but a clear negative reaction. What do you think this market reaction truly signifies?
It's that classic show me moment from investors, isn't it? The dip signifies a cautious, almost skeptical sentiment. They're looking for concrete proof of CAD uplift, as you said, and absolutely the finalization of that big Alewife life science lease before they'll re-rate the stock significantly higher.
So cautiously bullish at best.
Yeah, I'd say the sentiment isn't outright bearish, but it's definitely cautiously bullish. Acknowledging the positives, but clearly highlighting that EDA is still trailing the dividend, and they want to see that CAD coverage consistently above 1.0x before jumping back in fully.
And we have to remember the broader context, too. The mortgage REIT sector continues to face headwinds, right? Higher for longer interest rates, concerns about commercial real estate credit dispersion.
Absolutely. That context makes NexPoint's ability to execute on its pipeline and de-risk its life science exposure even more critical for building investor confidence. It's not just about their own performance, but their performance relative to a pretty challenging sector overall.
But management has, to their credit, outlined several key catalysts that could drive future growth and maybe a potential stock re-rating. Let's list them out. First, the formal signing and financing update for the Alewife lease expected early Q3. That's huge.
Huge. Second, the Q3 earnings print itself. Specifically, how actual results compare to those guidance midpoints for EPS, EAD, and especially that CAD number hitting 7.50 cents or more.
Third, the pace of originations and actually converting that $235 million pipeline.
Fourth, the trend in the dividend declaration, and crucially, coverage consistently above 1.0x on a CAD basis.
And finally, any asset sales or securitizations that enhance liquidity further.
Right. These catalysts directly address the market's current concerns. It's like they've laid out a roadmap for investors to watch. The onus is now squarely on strong execution in the coming quarters. Successful delivery on these points will be key to unlocking further value.
All right. It's time for This Is Not Financial Advice segment. This is where we pitch an outrageous but plausible trade idea based on today's call, kind of like a hedge fund analyst pitching to an investment committee. What have you got for us?
Okay, well, given NexPoint's recent share price dip, despite management's cautiously bullish outlook and these clearly articulated near-term catalysts we just discussed, maybe consider a highly speculative short-term long position.
Okay, speculative and short-term, what's the actual idea?
The idea, buy out-of-the-money call options on NexPoint, ticker INRF. Maybe looking at expirations in late Q4 2025 or Q1 2026 with a strike price around, say, $16 or $17.
Out-of-the-money calls. Why? What's the rationale?
The rationale is this. The market pushed the stock down because of that show-me attitude, right? Skepticism. However, management clearly articulated two significant near-term catalysts. First, that formal Alewife lease announcement, expected really any day now in early Q3.
Okay, Catalyst 1.
And second, the Q3 earnings print itself, where that CAD guidance exactly covers the dividend.
Catalyst 2.
Right. So the bet is if both these events materialize positively, the Alewife lease is confirmed, maybe with even better financing terms than expected, and Q3 earnings demonstrate that CAD uplift, especially hitting or beating that $1.50 midpoint.
Then the market sentiment could shift fast.
Exactly. The market could rapidly re-rate the stock, potentially narrowing its discount to that $17.40 book value pretty quickly.
Okay, so why is it outrageous and why is it plausible?
Well, this option play is outrageous because it's a high leverage bet.
Yeah.
You're betting on specific short-term execution in what's still a volatile sector. Options amplify gains, but also losses.
High risk, high reward.
Definitely. But it's plausible because the catalysts are so clearly defined and they're on short time horizon.
Right.
Plus, it's backed by that relatively low leverage profile, which gives management room to maneuver. It's essentially a bet on management delivering on its stated expectations and the market correcting its current skepticism swiftly if they do.
Interesting. A high-stakes bet on execution. So wrapping this up, what does this all mean for you, the listener? NexPoint Real Estate Finance is clearly navigating a complex market, but they seem to have a clear strategy and some significant near-term catalysts that could fundamentally change its trajectory.
Yeah, we've broken down their Q2 performance, those strategic moves in multifamily and life science, and the market's current cautious outlook. I think the key takeaway really is to closely watch that formal Alewife lease announcement. That's probably number one. And then the Q3 earnings report for tangible proof of CAD uplift and continued solid execution.
The market's patience has a limit, as you said, and NexPoint has laid out exactly what it needs to deliver. And as always, this deep dive is designed purely to inform your thinking, not to provide financial advice. Please do your own research, your own due diligence before making any investment decisions.
Absolutely. Consider how a NexPoint strategic focus on these specific, potentially higher yield sectors might either amplify gains or, conversely, concentrate risks within your broader portfolio strategy.
Thank you for joining us on the deep dive.
We encourage you to consider these insights and explore the implications further.
We look forward to our next deep dive with you.